Well, you see, okay, we're down to 42224 here. We've had sort of some declines here in SPX and the broad markets over the past few weeks. Let's just take a look at what we've done in the past couple of weeks here. Peak recently, of course, a couple months ago at about 4,600. And we've seen some lulls, then some comebacks and some other lulls, and try to come back and back to the lulls. Sort of bottoming out here, but we're seeing this negative MACD trend very shyly, but it's just starting to come at a negative MACD trend. We might expect some more bearish positions with everything that's going in the market. September, of course, has always been a rough month, and we saw that. But October usually tends to hold true. And remember, one of the common aspects that we discuss, not we ourselves discuss, but we see discussed across the gurus of the market, is that in general, the market tends to end a year the way that it began. Now, there's no guarantee. It's not ironclad or anything along those lines. But if we just go back to year to date, we saw some good start to January. This is year to date, of course. Some hesitation in February, and then some news that came out. Of course, Powell always speaks, and the market drops down and things of that nature. And we had some strong recovery for the last 4 months between then, and then we've had some hesitation. But in general, the sentiment is that the year tends to end the way it began. So what I expect is maybe flip-flopping, and you can write this down, jot it down, and tell me how wrong I was in 30 days and in 60 days. But maybe a flip-flop of the first 2 months where we might see some more still hesitation here as we saw in February to start off, and maybe the beginning of an increase, and then the continued increase that we saw in January to end out December. So that's one thought, of course, but with everything that's going on in the world, we want to be protected. We want to have hedges in place. And that's why we talk about some of those ideas for the broad portfolio protection, buying puts on SPY, QQQ, buying calls on volatility ETFs such as the VIX, VXX, UVXY as a broad market hedge for the unexpected, what we don't know is happening. We've seen a lot that's been happening, but we've also seen a lot of discussion with the labor market. We're waiting for some other reports to come out on that. We're not sure what Powell is intending to do for the next rate hike or not, but it's just something to always consider. I'm not saying go out and go full bullish. I think the approach for the next couple of weeks, and we see that the market sentiment tool has triggered into a light buy range right now based on the pullback that we've seen today. And the last couple of weeks, we're entering into the light buy. I'll get into that in a moment. But maybe sample with some light bullish positions in your portfolio going through the next 30 to 40 days or so, but keeping a background hedge in place. The VIX is up to 2171. So those VIX calls have been doing pretty well. We saw the VIX at lows of 13 and 14 recently in the past 6 weeks, past 7 weeks or so. Increases up to the 18, 19 range, now breaching up into the 21, 2171 range. So that webinar discusses when it might be too expensive to buy calls on the VIX as a broad market hedge and other alternatives that you might consider. But the market sentiment tool here, entering into a light buy, this is based on our 13 broad-based indicators. Ernie tested about 60 to 70 different market indicators several years ago, and he chose the dozen or so that gave what he felt was a precursor indication on various fences of those different positions, those different criteria, I should say, of when the market would start to turn. And you see here the 13 broad-based indicators, put-call volume ratio across the entire market, SPX number of days up, gap over the SMA 20, the percentage of stocks across the broad-based optionable market that are above their SMA 20. We can see that's almost entering into a bullish selection as well. It's almost right there where we'd have an indication of 4 bullish indicators and 9 neutral and no bearish. Percentage of stocks hitting their new 52-week high, the VIX itself, TRIN, RSI of the SPX, that's still in mid-range, number of days that the SPX is over the SMA 20, and the number of days SPX is over the SMA 100. gap over the 100, and the percentage of stocks over the SMA 100. We see that's in the bullish range because it's a lower value. And the MACD gap, which is just about to enter into bearish, of course, but as we saw when we just looked at SPX, we saw that crossover starting to happen. So this might flip. Now, what are these indicators based on? Well, essentially, they're based on fences. Looking back across historical ranges of these different criteria, and when historically they entered into a range that usually predicated a bearish market move or a bullish market move. Let's just take this percentage of new stock 52-week high and low. If I click on the details here on the Market Sentiment Tool, we see the histogram of historical ranges of the percentage of stocks hitting the new 52-week high and low. And we see here there's bearish when the value is above 8%, and it's bullish when the value is below 4%. And as you can see here, when we enter into this range, that negative 4%, it very rarely continues lower. It has a tendency to drift back up from the negative range back into the 0 range, maybe +1 or +2. But also, as you can see, very rarely when it hits that ratio of 8 does it continue to go higher. It sort of pauses at that time and reverts back to the normal. Okay, so that's all well and good, but that's what it's showing us is now that we're in this range below -4, the expectation is it's going to return back, which means stocks would start to increase, more stocks would start to hit that positive percentage of the 52-week high and low, and it's giving us the bullish indicator. It's in that range where it usually tends to revert historically once we hit this fence, once we hit this threshold, for example. All right. And all of the other ones you can see as well. Let's take another one. The number, let's take the put call. No, let's take the stocks above the SMA 20. So we see here stocks trading above their SMA 20. There's only 20%, roughly. Right now, it's the last value is 21%. So it's really close to that 20% range. When we hit that value, when it's below or at or below 20%, what ends up happening is, of course, you don't see many more continue to go down. It doesn't go down to only 5%, only 10%, and so forth. It tends to revert back, where stock starts to move back above their SMA 20 because the market is increasing. So that's what we've seen historically. That's where these fences are set between the bullish and bearish. And we have certain values, maybe 4 or 5 bullish indicators, which would drop this down, of course, to maybe 9, 8, 7 neutral, and no bearish. You'll start to go into those higher buy indicators, a bullish buy, very bullish buy, and a strong bullish buy. And on the reverse side, of course, we start to see the sell warnings. That's the light. Instead of the light buy, you see the sell warnings, very bearish sell warnings, and so forth. Now, over time, we can see that this has happened, what has worked for us historically. You can see also the history of these patterns when we went into the very bullish buys. Now, this might be a little bit confusing. Let's isolate it here. We'll take a look more recently, but let's isolate it here into some of these ranges. And what we see here on the blue line, of course, is the SPX closing price. And of course, when we start to hit certain ranges here, we start to see the bullish buys trigger and the market starts to recover. Let's take a quick look here. So we're seeing these heights and we're seeing the sell warning start to appear. We have a little pullback, and when it peaks down, we start to see the buy warnings. The bullish buy, light buy is where we are right now, of course, but the very bullish buys after this decrease, hey, we had a little comeback and we had some bullish moves here. And then when we hit this peak up here again, 4,600, we started to see the sell warnings predicated of a decline back down to this range. And we started to see some bullish buys here. You see the triggers up, the market's fighting it, then the dip, and then the market starts to recover after we trigger that second 2 in a row very bullish buys. And we hit the bottom. This is, of course, in 2022 we're looking at, or keep in mind. So as the market SPX started to fall again, we start to see those buy triggers, and it starts to trigger back up in price as well. More recently, Let's just slide this down here. So we're into the current market. And what do we see here? Well, we see some buy warnings here when the SPX is extending down into these ranges. And we see it come back up and the sell warnings start to appear, leading indicator, and then it goes back down. At that bottom, we see the buy warnings and it comes back up. We saw some strong sell warnings here, 6 or 7. It had a little hesitation, but the market fought it off. And then our last strong sell warning here looked like it was mid-July, right? We're at that 4,600 and we pulled back down, some light buy warnings. And now we've decreased back down here. We didn't see a sell warning actually trigger at this point, which I'm surprised about. Somewhere in September, I was surprised we didn't see it. We're holding in this neutral range. I was expecting to drop down into this ranges. The market sentiment did not. But now we're dipping down in here. We saw that strong buy recently. It came back up into the 44 range. Now it's delved back down. And as we saw, of course, we're starting to see that light buy. So not really a strong buy, as I mentioned. We're not seeing those bullish buys, very bullish buy signals yet. But we're starting to get into that range where we're seeing the light buys with the recent update. And it's might be some consideration to get into some new bullish positions. So that's just a review of what the market sentiment tool is, what we're seeing right now, and some past indicators. And while we're there, let me just go to our YouTube view. On the YouTube channel, I'm going to use the broad-based search here, and we're going to go ahead and look for market sentiments. Some of the other more in-depth videos, if you want to check that out. The market sentiment tool, that's from 3 years ago. Using the market sentiment tool for adjusting or placing trades, that's always a strong one. Well, that's too old. Looking for some recent one. Review of the market sentiment tool and current indicators. That was from 7 months ago, back in March. So we go through some of the same ideas and the same criteria. But this one's here, using the market sentiment tool for adjusting or placing trades. It's 20 minutes long. It's about a year ago. So that's a good presentation to look at. But there's other ones here about using the market sentiment tool for tracking and managing positions, and of course, navigating the market as well.